Joining me from Minneapolis is Jim Paulsen, Chief Investment Strategist at Wells Capital Management. Also joining me, Bloomberg Senior Markets Correspondent Julie Hyman, and from the New York Stock Exchange, my colleague Zahra Burton. Ladies, Mr. Paulsen, thanks so much. Jim, so much for things stabilizing after the White House and Congress avoided a debt default. Is the economy, as Ethan Harris of Bank of America Merrill Lynch told us today, still getting overwhelmed by shocks? And how does the global picture, specifically the debt crisis in Europe, factor into this?
Well, Mark, I think we've definitely slowed down, but I think that's more about the story of the first half than it is necessarily the story of the second half. I am already seeing a few weekly indicators that are showing a little better thing. I think unemployment claims this morning reported again have now been falling for several weeks and are down to about 400,000, which in some ways would suggest a good jobs report tomorrow. That makes me feel pretty good. I like the fact that weekly retail sales numbers have been very good here in the last 4 or 5 weeks. And I also like the fact that auto sales have bounced here in the last month, which is the first sign that the Japanese recovery is starting to positively affect the United States. The other thing I think that is useful is the market in its own wisdom is putting out some stuff that's going to help us. It's dropping mortgage rates, it's dropping energy prices, it's dropping the value of the dollar, which are stimulative events for growth. And finally, in recent weeks, the M2 money supply has just exploded to the upside, all of which are things that could help maybe stabilize the economy here in the second half.
Hey, Jim, it's Julie here. Now, as always, when you talk about rates coming down, when you talk about M2 and the money supply going up,
right,
the other side of the equation that you need, of course, is demand. And there, the numbers have been pretty mixed. You mentioned some of the positive indicators. On the other hand, you had ISM services, which is also a pretty current indicator coming out that was disappointing. You had pretty mixed retail sales, individual retail sales numbers today, particularly when you look at the mid to low end. So aren't we missing sort of that half of things, people actually buying stuff?
Well, on the retail, let's look at the weekly retail numbers. I think it's interesting. If you look at the ISC chain store sales, between February and the first week of July, they rose on average week on week or year on year 2.5%. Since July 5th now, in the last 4 or 5 weeks, they've risen on average year on year by 4.5%. So there's been a very notable increase just in the last few weeks in retail sales. There's no doubt that we went through a heck of a slowdown, and even the ISM numbers are still suggesting that the fallout from Japan and higher energy prices and higher mortgage rates are impacting the economy. I'm just saying that I see the first signs of that starting to change a little bit, and as we get to the fall time, I think we're going to see more and more reports in that regard.
Jim, it's Zahra here from the floor of the New York Stock Exchange. I just had an interview a moment ago with Todd Schoenberger. He's with Landcold Trading, and he was telling me, look, he is expecting, even though economists are looking for 85,000 jobs to be created in the month of July, he's looking for a loss of 35,000. And with that loss, he says the markets are going to continue sliding. We're now down 3.5% on the S&P 500, or just thereabouts. Where do you think the market could go tomorrow if we have a disappointing jobs report?
Well, I think if we get a disappointing jobs report, we're going to go challenge 1,200 on the S&P 500. This is the third time since the soft patch started in February that we've been down to the 1,250 area on the S&P. We fell there in March, we fell there in June, and then we fell there just the last few days. Yeah. We've now broken that. And there's a big gap between 1,250 and 1,200. But at the 1,200 area, there's a lot of support that we got last November in the trading at that level. So I think the market could fall as low as that area if we get a bad jobs report tomorrow. But we could have a good one, too. Expectations have been pretty low.
Jim, we have less than a minute left. My colleague Betty Lou posed an interesting question this morning on her broadcast In the Loop. Are we bottoming, or are we headed for a bear market? And are there any positive trends you're seeing going forward for the end of this year?
I really am kind of optimistic. I think we've been in a soft patch now for several months, so we've been already sort of consolidating and refreshing values. You now have the opportunity to buy the S&P 500 at a little over 13 times trailing 12-month earnings, 12 times this year's consensus estimate, when the 10-year Treasury is at 2.5%. And as I mentioned, we're starting to see some turn on claims and auto sales and retail sales. I think we're going to have a pretty good second half, Mark, but I'm just as scared as the next guy when you watch this free falling. And I like anyone else, I'm not really anxious to catch a falling knife. I'd rather see this thing firm up. I just think we're going to be, those who stay the course are going to be pleasantly surprised before the year is out.
Jim Paulsen, Chief Investment Strategist, Wells Capital Management, joining us from Minneapolis.